This is Business Weekend with Ross Greenwood.
Hi, and thanks for being with us here on Business Weekend. I'm Ross Greenwood. Coming up on the program today, the Medibank hacking scandal exposes massive gaps in Australian regulations and law. The company, it seems, will get away unscathed after the biggest release of the most sensitive personal information in history.
We did all of that. You can't lose what you haven't got. You can't lose what you've deleted 10 years ago.
And look, speaking of big scandals, the collapse of the crypto exchange FTX with a loss of more than $8 billion is going to put pressure on global regulators to coordinate and protect users. But it could also spell the end of the crypto boom as we've known it.
It's a safe and easy way to get into crypto.
Yeah, I don't think so.
And the boss of the online travel company Webjet reflects on his business's Phoenix-like recovery from a near-death experience as COVID and border lockdowns took his revenues close to zero.
So we've recovered, a third better than the overall market, and the best part of that recovery is it's accelerating.
All of that and plenty more here on Business Weekend today. But look, let's start the program by looking at this week. Medibank shareholders who overwhelmingly voted through their executives' remuneration packages. All the directors that were up for election held their places, again overwhelmingly, which appears to downplay significantly the company that's responsible for the worst hacking scandal in Australian history. 9.7 million customer records gone. The most sensitive information, which if released, could cause further extortion, severe embarrassment or cultural harm. But in a legal system that is clearly outdated, Medibank is likely to sail through this scot-free. Edward Boyd starts our coverage.
After 3 weeks of harrowing scandal and the worst data breach in Australian history, Medibank management and directors fronted shareholders to explain what went wrong. Why hackers were able to steal the personal, most intimate data of 9.7 million customers.
What has happened is deeply distressing. The weaponising of the private data of many Australians, our customers, is malicious. We are steadfast in our resolve to not reward this criminal behaviour.
Almost 20 shareholders asked questions at the annual meeting. Most were upset with what they saw as the company's lax approach to cybersecurity.
I am a shareholder and I'm rather disappointed that Medibank did not take security as serious as it should.
The security questions asked by Medibank staff for customer identity verification are the very information that was hacked and leaked. Will Medibank be reviewing the identity verification process?
My question is a simple one. I'd like to know, is there any member of the board of directors who has extensive information technology experience or expertise?
Yet strange though it may seem, Medibank directors seem to have come out of it all relatively unscathed. Shareholders voted overwhelmingly in favour of the company's remuneration report and the granting of fresh performance rights to the chief executive, David Kochhar. Medibank said it has appointed Deloitte to conduct an external review into the cyber attack and will release the results in coming months.
It will look to how this event occurred. It will look to what the ramifications of the event may have been, what consequences may flow, and how we may actually learn from the event to better protect our customers and our organisation into the future.
Medibank shares have plunged about 19% since the cyber attack, and you can clearly see the day that it was disclosed to the market on this chart. Medibank's market cap dropped from being worth about $9.6 billion on October 19 to about $7.9 billion this week. That's a loss of $1.7 billion. Australia's largest private health insurer says it's already spent between $25 million to $35 million responding to the attack, which includes hiring an extra 300 people at its customer call centre. But the true cost of the disaster is likely to be much higher when you include potential customer remediation and regulatory or litigation costs.
So, what can be done about this? Well, law firms we spoke with this week expressed frustration that our law has not adapted quickly enough to deal with large data breaches and the privacy issues that surround them. The avenue for action is the under-resourced Office of the Australian Information Commissioner, who's also the Privacy Commissioner. Well, David Vale is the chair of the Australian Privacy Foundation and is considered one of the pioneers of cyber law and policy in Australia. He joins me from his home in rural New South Wales. David, many thanks for your time today. Is it reasonable to say that companies like Medibank or Optus, under the existing law that we have right now, that really their boards, their management, anybody who's responsible for data breaches, it's really a tap on the wrist? It is no serious punishment for having allowed this information out there into the world?
Yes, look, Ross, that's basically right. I think everybody should be scared about the fact that most of the businesses, most of the directors, most of the senior managers involved in this, they won't even get a slap on the wrist. The worst they can get is they might appear on your show sort of in a bad light. There's reputation impact is almost the only thing. And for some of them, it's important, but they should also be worried about the fact that someone might be able to sue them, that, their part in causing all of the trouble and exposing so many millions of people to all that extra risk will come home. They'll share the pain. They'll share the risk. They will be forced to take responsibility for what's happened. As it is at the moment, it's all, oh, we're so sorry. We just want your forgiveness. Can we move on next week? Where's my bonus? That's the problem.
Okay, so tell me about the Office of the Australian Information Commissioner, because they have some powers, but it seems to me as though, and even I was talking to somebody this week who said even the Optus hack of 2019, that hasn't even been completed. So it seems to me as though it's not really the ideal organisation to be dealing with such significant investigations and breaches.
Well, look, if it was properly resourced and if it was like it was, at various stages in the past, it would be okay. We'd also need our own option in as we have in almost every other area to, if we're not happy with an informal complaint to them or a small-scale complaint, to go to court. And most people wouldn't do that, but that at least means you'd have an option if you weren't happy with them. But the real problem is that under the last, it started with the previous Labor government and it was much worse with the previous Liberal government. They've downgraded the whole thing. There used to be an independent privacy commissioner. Their only job was to sort out this stuff. They had, a separate focus, and they had teams that knew everything about this. They weren't lavishly funded, but they could cope with a few things. They were all bundled together into this thing called the Office of the Information Commissioner, which no one can say and remember. It's almost designed to be a bureaucratic sort of black hole that sort of, you hardly even know where it is, where it used to be the Privacy Commissioner, the privacy.gov.au was the obvious place. That doesn't exist anymore. And the problem was worse than that. They attempted to abolish it. They tried to actually get rid of the whole thing. And then when that didn't work, they allowed it to be underfunded. And so there's just not enough people there to deal with all of the complaints from, 25 million people. And they've also overloaded it with trivia. So with the data breach thing, there's this sort of back door where you go around and say, oh, please, can we not tell people that we lost their stuff? We've got all these excuses. We want you to have a look at this, and there's someone there who doesn't want to have to tell them about something else. They're not focused on the job. There is no actual dedicated privacy commissioner anymore. If they had the much extra resources that they would be able to do a good job if they went back to having, a dedicated freedom of information commissioner. So, you could find your records if nobody would give them to you, and a dedicated privacy commissioner and the information commissioner to do other stuff, encourage good practices. That would, crank up the office there. So it would be more like the scale they needed to do to deal with these massive things.
Okay, the one thing about this is I know the government and the Attorney-General are saying that they'll increase the fines to potentially $50 million, 3 times the value of any benefit gained, or indeed 30% of the company's adjusted turnover. But the problem there is, let's say in the case of Medibank Private, it gained 0 as a result of this leak. This is almost set up as though I, as a company, have given a hacker the information and profited from it. It's not as though my systems were lax and allowed this information to get out there, because I think that's the other really sticky part about this, that most organisations in Australia are keeping way too much data because of the era of big data, and all of their systems are arguably very lax to the sophistication of these hackers.
Well, that's right. You've touched on a whole lot of really good points there. On the last one, my sort of guru, Bruce Schneier, is one of the world's best IT security experts, basically says the game is up. The attackers have the advantage. You know, nobody can credibly promise you anywhere they can keep out a motivated intruder. You know, we saw 10 years ago, what's his name, Snowden, walked out the door of the NSA, the most secret place on the planet, with all their crown jewels, and then some hackers came and stole all their weapons and gave them away sort of last year. And if they can't keep everybody out, nobody can keep everybody out. And that means it's going to happen. The other thing he said is if you can't protect valuable, sensitive, personal information, commercial information, it's not the new oil, the new gold that all the big data industry says, we've got to do this. It's a toxic asset. It's, the more you've got, the more trouble you've got. And so underlying that is the push that's been in place by government and by business to just collect it all. The problem is they should be going on a diet. It should be trying to do more with less. We should collect less, keep less, keep it for shorter periods, and use it for less, and definitely disclose it to other people less. So if we did all of that, you can't lose what you haven't got.
David, always good to have you in the program. Lovely to chat. The chair of the Australian Privacy Foundation, David Vale there. Well, the revelation late last week by the Australian Federal Police that Medibank's hacker is Russian also correlates research done by Microsoft that shows sharp spikes in attacks against NATO countries and US allies since the Ukraine war began. Now, earlier this week, I spoke with Mark Anderson, the National Security Officer for Microsoft in Australia and New Zealand.
Hacking comes in two forms. I mean, we have the nation state, so nation state government-based actors, which is normally in form of some geopolitical objectives. But also we have a lot of cyber criminal gangs operating out of places like Russia, where they've been able to act with impunity by really being ignored by the Russian government. I mean, earlier in the year, they did actually arrest some of the Revil ransomware gang back in January, which was a good US-Russia joint operation. However, since the start of the Ukraine war, that has actually dropped off, and we are now starting to see a rise in criminal gang activity again.
Because the places you're talking about North Korea, you're talking about China, you're talking about Iran, you're talking about Russia. So these are the sorts of nations that are anti-NATO, anti-US, anti-Australia by that very nature.
Correct, absolutely. It always seems to be the authoritarian regimes, if you like. But moreover, what we've shown in this year's Microsoft Digital Defence Report is that we're also seeing other nations pop on there. So a good example would be we've also seen groups in Lebanon joining Iran in their targeting of somewhere like Israel, as an example. And we know that those two are correlated because the same tools that the Iranians are using to target Israel are also the same tools that the Lebanese gangs are also using as well.
OK, so you can see when Russia is attacking Ukraine right now, it attacks the electricity grid, the water. Now, cyber criminals, when it comes to state-based acts, are attacking exactly the same pieces of infrastructure.
Correct. They are attacking critical infrastructure, but they're also attacking businesses as well. I mean, one of the things that we call out in the report this year is the rise in what we call human-operated ransomware gangs. So whereas in the past, previously, a gang may just throw out a bunch of phishing emails, hoping somebody will click it and that's your next victim, human-operated ransomware gangs are actually researching their targets. And they're spending a good few months at this as well to understand what are their weaknesses, how do they get in, but also more importantly, are the types of organisations that will pay up and do they have the money to pay up? OK, so this is one piece of evidence that I found when I was researching this last week, is even though they will never be known and never be named, there are dozens and dozens of companies that have simply paid the ransomware because it's not illegal to pay a ransom in Australia. Now, the government seems to be now saying, well, maybe we'll make it illegal in the future. But until now, lots of companies have simply said, we're going to pay. And oddly enough, the hackers then take down the data because that's their business model. Yeah, I mean, there is an element of that where we have seen success, but at the end of the day, we also have to remember we are dealing with criminal organisations.
Of course.
They don't tend to be trustworthy. I think the whole idea of whether you should pay the ransom or not is pretty unique to every situation. I mean, traditionally, when the first wave of ransomware was out there, it was all about locking the computer. So the virus or the malware would get in, it would lock the computer and you wouldn't be able to use them. That was before they got cottoned onto the idea that what you should do first is extract some data and you can use that for extortion later on. In that first wave, it was more of probably if you took the legal and morale side out of it, it's more of a business decision. If your business is taking $5 million a day in profit and your systems are going to be down for a month, that's $100 million approximately you're going to lose. So would you, as a business decision, pay a $5 or $10 million ransom? Whilst it's not guaranteed that you'll get your data back and the tools will work, it's probably a good roll of the dice for some business organisations when they weigh it up like that.
But then when you get to something such as a Medibank Private, it is the data that has now been stolen that potentially compromises the customers. And that's where it takes on a completely different element, isn't it? It's not just the business that is the victim there, it suddenly becomes the customers of that business. Now, you know, as I say, in the case of, I'll give you another example, is Optus. There, it was a potential identity theft risk that was there. But in the case of Medibank, according to my theory, is it's actually the extortion of the individuals. And you can see that by the files that have been released.
Yeah, absolutely. And this is where it starts to become very difficult, because it does go back to that whole idea that whilst, again, it's not illegal to pay them, will they actually take that data down? Because unlike if you were kidnapping somebody and holding them to ransom, you pay the money, you actually get that individual back. They haven't taken a cloned copy of that. You know you're getting the thing back. In the whole idea of ransomware, they are taking copies of your data. So you are relying that they're not going to do that. Moreover, you're relying on that another part of that criminal gang doesn't decide to go off and do their own thing and release them as well. So it does make it a very tough and difficult situation to say whether you should or you shouldn't pay in these scenarios. Personally, I'd say it would be one of those moments of where it might stem the bleeding for now, but ultimately that data could reappear at any point in the future.
But the one thing about this, Mark, is that Microsoft has phenomenal information here. And then on the other side, quite clearly, so does the Australian Federal Police, the Australian Signals Directorate. There is a large amount of knowledge and information about the hackers, where they're coming from, who they're targeting. And so the strange thing is getting access to take any criminal records or action against those people. That's a totally different game altogether.
Yeah, 100%. And if you think about the actions that we can take, I mean, it is a global game of whack-a-mole because these gangs are popping up all over the place. The work that we do, we have a team within Microsoft called the Digital Crimes Unit, and this is a global team that does all the things that are nasty on the internet, taking down exploitation material, and ransomware gangs is also one of them. But the only way we can do that is through legal and technical means. So if we can spot where their infrastructure is located, hopefully it's in a country that has a mutual legal assistance type capability where we can work with law enforcement to go and seize that infrastructure, we can start to disrupt it. However, the one thing we can't do is offensively attack that gang, because that ultimately is hacking, and that's illegal in pretty much every Western country. So yes, as a private organisation, we can't do that. But if you think about in Australia and the recent announcement by the Minister, we're talking about now we're bringing ASD, or Australian Signal Directorate, into the picture, and they do have the legal tools and legal remit to be able to hack back. So it really provides another tool in that toolbox, but it is ultimately a global game of whack-a-mole.
But the other thing as well is, as time goes on, it is the cost. Clearly, the business model is lucrative for the hackers, otherwise they wouldn't be spending the time and the energy. And as you make the point, and this is what was really, you know, sort of standing out in the Medibank situation, is the knowledge even of Australia and of that database and of the people in that database. So there was research that had been done. There was local content that was being added to this. It's trying to fit the pieces of that puzzle together, really, isn't it? That the crime-fighting authorities, organisations such as yours, are trying to do right now.
Yeah, it's also to add complication into the mix as well. And again, something we talk about extensively in this digital defence report we recently published is that cybercrime as a service is also on the rise. So what this means is that traditionally, cyber criminals used to have to build all of their own tools and execute their campaigns themselves. What large-scale criminal syndicates have realised is that they can actually make money by building it as a service. So if I wanted to go away and target an organisation, I need next to little technical skills. If maybe I'm no good at gaining entry, but I'm really good at the extortion piece, then I would hire somebody to do the entry piece and then take over from extortion. But this cybercrime as a service industry has now got to the point where somebody could just walk off the street and effectively say, I want to target that organisation, and then the cybercrime gang would take over, and then you just take over the negotiation.
Coming up after the break, we explore the collapse of cryptocurrency giant FTX and look at how you might stay in the money with more traditional investments with Perpetual's Matt Sherwood. Thanks for being with us here on Business Weekend. The regulation of crypto exchanges, well, that was pretty much non-existent. The protection of consumers seems scant, regardless of the risk that those consumers were taking. So this is likely to be an inflection point for crypto assets. Less Wild West, more rules and accountability by the very governments that crypto players had sought to avoid. Caroline Bowler is the Chief Executive of BTC Markets, Australia's biggest digital asset exchange with more than 300,000 local clients. Caroline, many thanks for your time. Can I just start about that issue about regulation? Because it seems that it's coming. You can't have consumers with an $8 billion black hole, money being used, being leveraged in other companies, effectively almost, if you like, in a Bernie Madoff type scheme. This is the real problem here, and this is about the impression and the image of the overall asset class.
Yes, absolutely. Firstly, thank you so much for having me on. But secondly, I think as an industry here in Australia, we're in broad agreement with those exact points. Certainly, it's something that we've been agitating for the last couple of years, both individually as organisations, but also through Blockchain Australia, who are the local industry peer group, if you like, that have been directly talking with both government, Treasury, ASIC, etc., on these very points. Certainly, if you look to the Senate committee that reported in October of last year, they actually had put forward in recommendation points around custody, talk about regulation of exchanges, and various different points that I think if they had been in place in this scenario, perhaps would have prevented the losses that we've seen with FTX.
Okay, so there's one issue here, Caroline. I want to go to the heart of this because it goes to any asset class. Doesn't matter whether it's property in the old days or mortgages, whatever it might be. It's actually about liquidity. It's about the fact that when a person turns up to say, that's my asset, I need to cash that in, whatever the price is, that there's liquidity to be able to do that. That's one of the keys. The second thing is that my asset has not been misused, as it was in this particular case, for some other purpose. Now, the fact that it was misused and as a result then the liquidity issues happen, the people can't get their money out.
Yeah, absolutely. I think what we've seen perhaps has been a replay of MF Global, which is nearly 11 years ago to the day where in traditional finance, we saw a similar scenario where client funds were used to prop up an insolvent firm. And after that, that was also sitting in keeping with the rest of the issues around the global financial crisis. We saw regulation come into play very strongly there to protect the investor. And I think it was those lessons, the learnings from that time period certainly influenced me and my role here at BTC Markets to try and put in place as much of those controls as we could in the absence of regulation. So if you like, to a degree, there's been a certain amount of self-regulation here from the industry in Australia. And certainly through Blockchain Australia, the governing body for the industry, they have got a certifying of exchanges that all meet these particular types of behaviours. So as I say, in the absence of any regulation, the industry has been trying to do the job itself. Now, do I think that's a type of situation that can continue in perpetuity? Absolutely not. We definitely agree that there is a very clear role for regulation in this space. And we're very pleased to hear the announcement from Treasury earlier this week that that's exactly the points that they're going to be moving forward on. We look forward to working very closely with Treasury through the consultation period on these exact points.
There's some irony in this collapse in some ways, isn't there, Caroline? Because blockchain, which everybody acknowledges, is a brilliant way for custody of assets. And in the case of cryptocurrencies, the one thing is it's yours, you own it. So to have people lose control of their assets under these circumstances, that's the bizarre thing about this. Because if I've got the blockchain code, then under those circumstances, they're my assets. That should never change.
Yeah, absolutely. I think that's what this boils down to, is being able to generate trust. The joy with blockchain transactions is that they're supposed to generate a trustless type of trust, in that in the absence of trust, that the technology works as it should do. And certainly if you look at some of the developments within the technology, things like smart contracts with automatically execute without the need for intermediaries, that's exactly what they've built. But the problem that we found in this case with FTX is that it was through centralized exchanges, such as myself at B2C Markets, where that control was handed over. Now, under ordinary circumstances, that's absolutely fine. It's the same in traditional finance. You leave your cash on deposit at a bank, but a bank is regulated, and they've got obligations of reporting. They've got obligations to government. They've got obligations to a range of stakeholders. And because the crypto industry itself doesn't have those same stakeholder obligations, scenarios such as what's happened with FTX, those opportunities are created. That, as I say, is not the case for the majority of the industry, and that's something that we're very keen to rectify, so that the good actors, such as ourselves, have the opportunity to display that and demonstrate that trust, repay that trust from the Australian investor.
Caroline Bowler, Chief Executive of BTC Markets in Australia, many thanks for your time on the program today.
Thank you very much.
Now, just before we leave crypto, we can't help but play you the advertisement that FTX itself, the company that's now collapsed, put out for the US Super Bowl this year. It won awards for it. It stars Larry David, famous for Seinfeld and Curb Your Enthusiasm. Ironically, David is among a group of celebrities now being sued by disgruntled FTX investors.
I call it the wheel.
I don't think so.
Hancock, you sign first.
No king! Gentlemen, have you taken leave of your senses? The people shall have the right to vote. Even the stupid ones? Yes. Stupid people vote? Yes.
Edison, can I be honest with you? It stinks. Does your wife know what's going on here?
She knows I go to work.
You're wasting your time, and it's sad.
Like I was saying, it's FTX. It's a safe and easy way to get into crypto.
Yeah, I don't think so. And I'm never wrong about this stuff. Never.
Franklin! Hey, I left my cane in there. What? What do you mean? Hey, that's an expensive cane!
Well, from the wild world of crypto to the wild world of traditional investments. Well, it might seem that way as inflation remains stubbornly high with the promise of even higher interest rates. Yet, unemployment is so low both here and around the world. Let's bring in Perpetual's Head of Investment Strategy, Matt Sherwood. Matt, always good to have you on the program. I want to take you to that exact point. This time around, as compared with previous recessions, the difference is the unemployment rate is so low, which means consumers can absorb price rises from the higher inflation. That means while unemployment is so low, that employees are actually growing their businesses, looking for more labour. This is the disconnect to me for the investment markets.
Yeah, it's a much more complicated cycle this time, Ross. And the way I like to think about it when I'm talking about it with my clients is to think of the economy in terms of a train. Right at the head of the train are the surveys, so the PMIs, the ISM sort of thing. Policymakers are right behind them. And then about 2 or 3 stations back is unemployment and inflation. So they are lagging indicators, and there's no doubt around the world that unemployment is very, very low. Interest rates are rising aggressively, and as you said, inflation is at 40-year highs and double-digit in some countries. And it seems somewhat inconsistent, the signs that we're seeing, but I think the labour market and inflation are the lagging indicators. I think their unemployment's going to go up next year when we see the impact of the policy tightening begin to hit household spending. That's going to be the key. There's always a lag there of about 1 to 2 years. So to me, it's looking like a 2023 story.
Okay, but then it comes back to earnings, because the stock market always follows the earnings of companies. Because what it says to me is right now the earnings of the companies might be okay, but there almost looks like there's a brick wall approaching very, very quickly. If what you say is right, that the interest rates eventually catch up, that eventually the employers stop employing. Now, that also means their earnings are going to be clipped at some time down the track, which means that the euphoria right now of markets rising as the expectation of lower interest rate rises in the future is coming around, that might be a bit of a false dawn.
Yeah, I've been very surprised how well the market has hung together, just given how aggressive these rate hikes, not only from the RBA, but also from the US Fed and all of their global peers have actually been. Yes, the market's off, quite substantially this year, between 15 to 20% globally, but I actually think they've held in quite well. And I think the story this year has been falling valuations as real interest rates rise. The story next year is going to be the impact of those higher interest rates on earnings growth. So our suspicion is next year we're going to get a bunch of rolling recessions, and that's going to weigh, as you say, very heavily on the earnings outlook. And on average, an average US recession leads to a 20% decline in earnings, and analysts at the moment have got earnings growing 7%, not only growing, but growing above average. And to me, that's just not sustainable. I can't imagine that being resolved, particularly with all these cost side pressures still there, which are squeezing margins. So there is going to be a catch up between where the markets are at and where the corporate earnings are at. At the moment, it's hanging in there. You only have to look at the last US reporting season, or the current one, I should say. Expectations coming in were for about 3% earnings growth. It was a bit less, but it was still positive. Take energy out, though, expectations were -3%, delivery was -5%. So to me, I think the tracks now are starting to get laid of where corporate earnings are heading.
Okay, so you make the point there that earnings per share growth, or earnings growth, if you like, profit growth, that's the key to drive the stock market. Now, you've put a couple of charts together for us today. We go to the first one, and this one is really about the global earnings, because it actually shows there's a correlation between share price movements and really where the earnings and the earnings growth is. So it's not just the earnings, it's actually the growth in the earnings that's the key.
Absolutely. And what the model is showing here is that by the middle of next year, earnings for the MSCI World Index, the model estimates are going to be -12%. Expectations, as I said before, are about 6 or 7% up. This is saying down. So that's starting to be a pretty big earnings disconnect. And there's two things which drive markets, which are valuations and earnings. And to me, this is where the mispricing is actually at. And we already know that Europe and the UK are heading into recession right now. The big drag by the middle of next year on global earnings is, in fact, Europe. Our model for that is at -22%. Other regions, such as America, aren't as bad. And that's simply because the labour market hasn't been broken yet by the Fed. And we suspect that's a story for the second half of next year. And that's where we start to see the earnings recalibrations and material downside risk from here.
Okay, so then we bring it back to Australia, because at the moment, Australia is aiming for the so-called soft landing. That would be the preferred approach of the Reserve Bank. So we have a look at exactly the same chart we just showed you on a global basis. Your chart is now showing Australian earnings per share growth versus where the stock market is. And what this implies right now is that there is a big earnings cliff coming, and that would imply that, all things being equal, the stock market should follow that down.
Yeah, well, there is an earnings decline coming, but it's not as bad as what we're seeing globally. And what's helping the Australian market, at least, is the fact that the exchange rate is seriously depreciating. And what that means, well, it's depreciating relative to where it was 12 months ago. And that does give some support, particularly for our global earners. But in the end, Australia's going to be caught in the same wash that most other markets are in at the moment. Growth is slowing. Interest rates are going to grip the economy next year, particularly in the second half. And as a result, corporate performance is going to be under pretty serious scrutiny, both from the revenue line, but also because a lot of these cost side pressures are going to be there for an extended period. And as a result, it's not only lower earnings, but particularly driven by lower margins. Australia does have a couple of advantages. Our economy probably looks a little bit strong. I think the RBA is nearly done. So I tend to think there's only probably 2 more rate increases here at the most. That gives us a better chance of a soft landing relative to other global markets like the US, Europe and the UK. But I think relative to other cycles and tightening cycles by the RBA, recession risks here are probably a bit more elevated than what they have been in the past. And that's because the state of household balance sheets in Australia is not good. It's very, very leveraged, and that means RBA policy has a much bigger impact on household spending decisions when those borrowers move off the fixed rates onto the variable rates. That will lift their interest rates from just over 2% to just under 6%, and that's a pretty significant hit to household disposable income. So we're going to see that in the second half of next year.
Perpetual's Head of Investment Strategy, Matt Sherwood. Always good to have in the program, Matt, and many thanks for time today.
Thanks for having me, Roscoe.
Coming up after the break, after a near-death experience, Webjet rolls back to life. We speak with Chief Executive John Guscic, and how to keep spending after you've died. Well, the commercial implications we explain of the metaverse. Thanks for being with us here on Business Weekend. Well, this week, online travel company Webjet said it's back in the black after it lost $60 million in the first half of last year. But as Chief Executive John Guscic told me this week, it's been a long climb back from an almost terminal position when borders were closed and the travel industry had pretty much shut down. John, many thanks for your time. Can you contrast your business today with what it was like in your mind 18 months ago?
If we went back sort of 6 months beyond that, it was obviously a complete disaster. We had a business that was turning over circa $4 billion in sales, and that went to zero in the space of 3 weeks. And you've got a cost base of circa $40 million, and you're running out of cash. That was high stress. And as you're aware, we raised an emergency capital raising and refinanced the business, which was positive, and it was great to see the support we got from all of our major shareholders in that endeavour. But when we get to 18 months, we're starting to see that we've sort of bottomed out and there's just minuscule recovery in very, very small pockets of the market. And what we've seen since, obviously, is a rapid recovery, and we've been a beneficiary of some of the decisions we made during the pandemic to retool our business to enable us to grow and hopefully thrive in the new environment.
But it seems to me that just looking at the Bureau of Statistics numbers, that the level of inbound tourists and outbound tourists in and out of Australia is literally only a little over half what it was previously. So does that mean there's more upside to come for the business?
Australia is actually a laggard in the recovery from an international inbound and outbound perspective. There's, as you just rightly identified, there's only 50% of people coming into the country that was coming in pre-COVID, and 50% of Australians who are leaving compared to pre-COVID. On a global basis, that looks closer to 75%. Now, our business at an activity level of bookings across both our OTA business, which Australians will know as webjet.com.au, and our WebBeds business, which is a wholesaling business, our business, we're already at 100%. So we've recovered, a third better than the overall market. And the best part of that recovery is it's accelerating. So in the current quarter, which is our Q3, which is 6 weeks old, we're up now 30% ahead of pre-pandemic numbers at both booking and TTV. So for our business, what's happening in Australia is important, but it's not the driver of the overall success that we're going to have, because we're a global business and the vast majority of our earnings occur outside of the shores of Australia.
Okay, so how much of that is volume? In other words, numbers of people coming through versus how much is price? Because people are conscious that airfares, the price of hotel rooms, has gone up significantly over the last 6 to 12 months.
Every travel business in the world has what you've just described, except for us. We are an outlier because we've changed the mix of our business. On a global basis, we're selling a whole lot more domestic and we're selling a whole lot more in North America. The length of stay for those hotel stays are substantially shorter than what they were pre-pandemic for our mix of business. If you just check a hotel room on a typical room night, you're talking 20, 30% higher now than it was pre-pandemic. But for our business, we're actually down, believe it or not, 13% on an average booking value. That's because the length of stay has been shorter because of the nature of where we've pivoted to as a consequence of decisions we made in the middle of the pandemic.
Okay, so then take me to airlines as well, because you deal with them.
Sure.
Tell me about their decisions, because clearly this is about capacity.
Yes.
Many of them are beyond capacity right now because they've taken flights out of the system, and prices have risen accordingly. Yes. Is this the right strategy long time? Because at some stage, consumers, surely travel consumers, have got to reach a brick wall where they say, we can pay no more.
I think if the question's in the context of the Australian travel market, it's 100% correct that the constraints and the supply constraints that the airlines have put in, and that's not a factor of one particular airline, it's a factor of some structural elements. So if we roll back 3 years or so, the Chinese airline carriers contributed roughly 20% of the outbound capacity in Australia. That's zero. So you've lost that anyway. And then the balance is just starting to come back out of hibernation. And as you're well aware, the supply chain issues that the airline industry has are very difficult to overcome. You have to basically retool your entire operation from a standing start. That's taking a little bit of time. But I think over the course of calendar year 2023, you'll start to see increased supply, and you'll see prices come down as a consequence of those increase of international capacity. And once more international capacity feeds in, the domestic capacity will also rise. And I think the bite that we're all currently feeling on domestic prices will be subsiding.
I'm wondering about the travel industry and the lack of Chinese tourists. Just what does it do to the travel industry if China starts to re-engage with the world and sends its tourists back to places such as Australia?
In the simplest forms, if the Chinese outbound tourism was to kick in and Australia became an attractive destination, it'll end up being lower prices for you and me. That will be the end effect of all of that, and it'll create great stimulus for the travel industry itself, and we'll go back to full employment for hotels, tours, activities, airlines and the like. So it'll be great news if that détente was to be achieved.
John Guscic, many thanks for your time today. Appreciate it.
Thanks, Ross.
We spent plenty of time today talking about the importance of customer data to consumer brands and indeed to all companies. But let's take it to another level. Imagine a day when so much is known about you that you don't actually have to make a conscious decision to consume anymore. It'll be done automatically for you. Welcome to the metaverse, the virtual world where your character can shop, learn and interact. We've explained it to you before as Facebook owner Meta launched the concept, but now has spent billions of dollars on it. But even more companies are now developing in this metaverse, and all of it is based on data.
In just 10 years, the way that companies attract, retain and engage with customers and stakeholders has changed dramatically. Enter the metaverse, a highly evolved augmented reality technology developed through innovations in the cloud and machine learning. Thanks to these new technologies, businesses can now interact and learn from customers in a highly personalised way. Is it science fiction? Not quite.
I think what we saw was with COVID a really huge acceleration in terms of transformation and organisations really reorganising themselves to meet the challenges that existed through that period of not being able to be face-to-face, of having to find a way to be creative and still engage their customers.
What's emerging is not only a new way of working, but a brand new way of thinking about how to do business.
We have a distinctive view on the metaverse, and that is that it's a continuum. It's the spectrum from the physical world to the virtual, and it's new technologies that evolve in that space over time. And we see this in the future will likely revolutionise the way that we do business and the way that businesses engage with their customers. Already we see customers and employees engaging with workplace and shopping in a different way than in the past. It's a blending of synthetic worlds where we have the physical world, which remains tremendously important, but augmented reality, extended reality, virtual reality, and ways of learning and shopping and experiencing and meeting. A whole range of different experiences can happen in these different synthetic environments. And technology is allowing us to consume and participate in those, which hasn't been possible for us at an enterprise level in the past.
At the core of this new virtual model of business is data. The continuum, as coined by Accenture, is the ever-evolving customer experience. It's about learning from the ongoing exchange and analysis of user data.
Businesses can look to net new revenues, new ways of engaging customers and new ways to create amazing experiences. Secondly, I think there's a great opportunity for efficiencies where we might not need to travel. We might be able to do training in virtual reality, or we might be able to take people out of dangerous situations to create experiences for them to learn without putting them in harmful environments. And then thirdly, there's a space to play and participate.
The end result for customers is a highly personalised experience. The initial focus is all about convenience.
It's about understanding not just, say, the products that they like, but also the channels they've engaged with, maybe the segment that they come from, the business they belong to, the end-to-end way that they might interact with your organisation, so that you're really servicing every part of that customer and really serving it up to them on a platter in terms of being individualised in an experience for them.
But with large masses of customer data pouring into the metaverse to drive innovation, there is increased responsibility for business and for developers. But that responsibility is about the way highly sensitive personal information is protected to maintain trust with customers.
The important thing is to be prepared for it, to have protections around all of the systems that contain customer data, and to really understand what data you're holding and why you're holding it, and to not be holding on to data that you perhaps don't need to.
So what does this new method of virtual business look like? Accenture has partnered with Google and Telstra to create a wayfinding service, a highly evolved version of Google Maps using augmented reality to help you get around in public areas.
So it's taking that same technology, but it's mapping the physical world around you and overlaying that with digital signage or digital character interactions that allow you to navigate through those spaces through a more immersive experience than just Google Maps.
So what this does is it works by identifying, it knows where the walls are, so the chevrons get dropped into place. So you imagine you're walking through a busy shopping centre, you're interested in shoes, this shoe shop you've shopped at before, they decide to offer you a discount. We can pop up contextualised information specific to you as an individual that says, hey, Steph, you really like shoes, how about we give you 10% off today, and kind of attract you into that store.
The Accenture wayfinding service was only made possible by bringing the pioneers across industries together, using Google's geo-mapping expertise and Telstra's vast experience with 5G technology. It's a great example of why partnerships and collaboration are critical for driving innovation in Australia.
What we're really trying to do is to open some of these technologies to partners like Accenture and allow them to innovate in new industry spaces and against new industry verticals. So it's not only the AR Core Geospatial API with Google Maps, but more recently things like Google Earth Engine, where we're allowing our technology partners to collaborate with us using some of these new developments in technology to create that much more immersive and digitally rich experiences for our customers and frankly all Australians to benefit from.
Technology is rapidly evolving. The possibilities are extraordinary, and not just at a commercial level.
And it's really exciting. If you wind back kind of 8-9 years, Accenture really talked about digital and how every business was going to be a digital business. And people were kind of like, that sounds a bit crazy. There's always going to be face-to-face. But it's proven to be true. And I think metaverse is really going to be that next frontier, and it's already starting to bed in certain industries. Retail has really embraced it. Other industries are jumping on board now as well.
The opportunities for using this type of technology are absolutely infinite, and I'm sure it's only the start of where we'll see this kind of cloud-powered AR 5G technology being used across a heap of other different industry sectors.
So that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but don't forget you can keep up to date with all the latest business news with our daily program, Business Now, 4:30 and 11:30 p.m. Eastern Summertime. You can also rewatch the program via our website, skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.